Hello, welcome to the fourth quarter 2016 Nepsis Capital Management Quarterly Update. My name is Mark Pearson. I am the President and Chief Investment Officer at Nepsis Capital, and once again I want to thank you for taking the time to hear the update. We also have a hard copy update for those of you who prefer to read it. That will be available here as well. I want to personally thank you again for the opportunity for our firm to be the steward of your resources as we take the decisions we make on your behalf seriously based on our processes that are proven over time. We got a lot to cover today. Obviously, the election has passed. If you did not watch our third quarter 2016 update, I'd encourage you to go back and take a look at some of the things that were said and find that many of the things we talked about have played out exactly what we thought. Certainly most people thought that the election was going to be the big thing, that a big correction was going to take place. Unfortunately, correctly, I am saying unfortunately, we did not get much of a correction at all. In fact, the markets have been on a tear ever since the election. And if that does not give you another indication of why it is time in your investments, not timing your investments, 2016 has been that. As we started the year with roughly a 12% correction in the S&P, with bank stocks, oil stocks getting hit, into Brexit, into the election, there were many things to keep investors on edge. But as you know, if you follow us at Nepsis, we told you, we will continue to always tell you that fear, uncertainty, and doubt do nothing but create opportunities to take advantage of investing in great businesses over time. Of course, we like to tell you we don't invest in the stock market. The stock market is nothing more than the greatest tool ever created to bring buyers and sellers of businesses together to take advantage of buying great businesses. So today, in our outline here, we're going to begin with talking about the quarterly report last quarter and the topic of no bull. There was no bull when we did the third quarter last year. People were extremely pessimistic, extremely nervous, and we told people we love that pessimism. And of course, there was plenty of bull to go around as the markets continued to go higher, led by the banks. We're going to talk about the banks here in a little bit, and brought us to the end of 2016 on a strong note. We're going to talk about the new headline for this quarter titled, "Time to Get Off the Bench." Using a little bit of a sports metaphor here, we're going to talk about why it's time for you, the investors, to get off the bench. We're going to reiterate again, I think it's important to discuss with you, to explain to you our investment process, why we make the decisions we make, why we are going to have periods of success and other times we won't have as much success short term, but historically longer term has provided great success. So we're going to talk about that. The ever-elusive correction. I come on here every quarter talking about when are we going to get that 20% correction. Historically, according to Morningstar, 20% corrections happen about every 5 years, one every 5 years. We haven't gotten it. Maybe we'll get it. We got about 19% back in 2011. I don't know when we're going to get it, but frankly, I don't care and neither you should care. And we're going to talk about that as well. The topic we introduced last quarter, the headline versus the bottom line. The focus of the headline versus the bottom line. What should you be focusing on if you are going to invest with success and invest for success? Because ultimately, isn't that why we invest in the first place? And lastly, we'll talk about the markets, what our projections are, what we think is going to happen in 2017. Of course, let me begin, since this is being recorded in January, obviously. I hope you have had an opportunity to go to nepsiscapital.com, check out our, once again, annual 2017 stock market projections. This is our 7th year doing our projections, and I don't mean to brag, but once again, we were 10 for 10 in 2016. I'm hoping we will be in 2017. And of course, if you are diligent in following all of the ridiculous prognostication, postulation, and speculation that goes on in the financial services industry, I think you will find that most people are not correct in their speculating and prognosticating. We are proud of the fact that we are. And I think if you go to Nepsis Capital, you read the top 10 predictions, I think you'll find them, number one, entertaining, and number two, extremely educational, and an ability to enhance your investment success. So, it's time to get off the bench, folks. It's early in the year. We're already fielding emails and phone calls from investors asking the question, why did my portfolio not do as well as the Dow Jones Industrial Average? Why did my portfolio not do as well as the S&P 500? And we get those questions often, particularly we have often over the last 5 years, as the U.S. markets have been some of the best performing markets, certainly performing better than the international and emerging markets. By the way, not the case the 5 years previous from 2005 to 2010, but unfortunately investors think short term, not long term, and that inhibits their ability to be successful in investing. The title, It's Time to Get Off the Bench, refers ultimately to the ideal, it's time to stop using benchmarks. We've written a white paper about it. We talk about this incessantly on our radio show. I'll give you more information on the radio show at the end of the recording here. But it's time to stop using the S&P 500 and the Dow Jones Industrial Average as benchmarks. And let me be bold, let me get on my soapbox. It's time to stop listening to the media telling you that you should buy index funds and that most money managers underperform the S&P and the Dow. The fact of the matter is, the comparisons that the media and the financial industry give you are inaccurate. They are not giving you apples to apples comparisons. And remember, I've talked about this before. The financial services industry and the media are in the business to, yes, educate, give you information, but they're also there to engage you in making a transaction. Because when you make a transaction, they make money. It's a simple process. And many of them can care less if you make money. They're going to make money on those trades. When you buy those products, when you buy those investments. But let's be blunt about this for a minute. Do you really want computers making the decisions on your portfolio? Do you really think that cheap indexes are the best way to invest? I always say to investors, why do you want to invest in average? Why not invest in above average? The problem is that the financial services industry is ingrained in investors' heads that they should check their portfolio value and the performance of their portfolio on an annual basis. Who said that's the right thing to do? Who said that's the best way to gauge whether or not your portfolio is doing a good job or not? And this idea of a race to a bottom on who can give you the cheapest prices, the cheapest fees on ETF index investing, to me, I think is ludicrous. I mean, thank God we don't have just McDonald's restaurants out there. Could you imagine if everybody focused on just buying the cheap hamburgers? We wouldn't have steak. We wouldn't have fillets. We wouldn't have New York strip. We wouldn't have Ruth Chris and all the beautiful steakhouses and the great hamburgers we get to have with barbecue sauce and cheddar cheese and all the other stuff. We'd all be going to McDonald's getting the $2 hamburger. Now, no offense to McDonald's, but here's the analogy I want to give you about getting off the bench. Folks, who wants to be average? Who wants to invest in average? The problem is, if you want to be above average, it does not happen over short periods of time. It happens over longer periods of time. The best athletes in the world, the best preachers, the best teachers, the best marketing people, the best people in whatever it is you do, it does not happen in a year. It happens over time through a proven process. Investment success, investment returns come from a proven process. I often say, if you want to have a McDonald's portfolio, it may taste good in the beginning, it may feel good in the beginning, but have you ever sat down and had 2 or 3 McDonald's hamburgers at one time? How'd you feel a couple hours later? And imagine if you sat and ate McDonald's hamburgers and that's all you ate for 5 years. It would taste good in the short term, you'd feel good in the short term, but what's the long-term impact? High cholesterol, high blood pressure, overweight, unhealthy? Probably. If you're a short-term thinker in your investment, folks, that's the way it's going to be. Now, I talk about this often. Do not benchmark your portfolio. Whether you work with Nepsis or not, work with your advisor. Look at understanding what you own, why you own it, and understanding the investment process. And lastly, how is that process going to enable me to accomplish the goals I've set forth for myself over time? Eating a McDonald's hamburger satisfies a short-term goal, fills my stomach, gives me food. But does it satisfy my long-term goal if I keep eating McDonald's hamburgers? If I keep going to cheap, cheap, cheap? If you want cheap, we're not it. We're about process, and we're about investing for success utilizing a proven process. Time to get off the bench. Now, you may be saying to yourself, well, that's fine, Mark. What do I use to gauge if my portfolio is doing a good job? I mean, my portfolio was only up 4% this year and the S&P was up 10 or 9. What do I do then? What you do is you talk with your advisor, you look at your portfolio over time and its performance, and are you on track to hitting your long-term goals? That is the most important question. I often say, you can't put a price on clarity. And if you want to use machines and you want to invest in the average, you go right ahead. Now, full disclosure, in 2016, our portfolios did not perform as well as the metrics that we use. You heard me. We did not perform as well. Now, I could be flippant and say, so what? And you could be sitting there saying, well, why should I work with you if my portfolio didn't do well this year? Well, maybe it's a bad McDonald's hamburger and it got sick this year. Longer term, we continue to do well. Our numbers are showing that once again, just like the previous 5 years, the last 5 years, our client portfolios, on average, give or take, because everyone's portfolio is a little different, outperform the benchmarks, metrics, whatever you want to use, by roughly 25%. If I come to you every 5 years and say, our goal is to outperform a benchmark, appropriate benchmark, if you have to use one, by 25%, are you willing to stick to the process? I certainly hope so. The noise of the media talking about how money managers don't perform as well as a benchmark is because you're not getting an apples to apples comparison. Risk-adjusted return. How much risk do I take to get the returns I get? That is the most important question. Besides, is my portfolio going to enable me to accomplish the long-term goals I've set? Don't chase the immediate gratification. Don't chase the salty, tasty hamburger. Chase the steak. Look long-term. Let it cook. Let the steak age. It's not timing a stock or timing a market. It is time in a market or time in a portfolio. Get off the bench. Now, why should you not look at our portfolios relative to the S&P or Dow? By the way, the Dow did better than the S&P this year. I find it kind of funny and interesting. This year, investors have been asking more why their portfolio didn't do as well as the Dow. Where historically they ask why their portfolio hasn't done as well as the S&P 500. It's interesting, investors pick the index that's performed the best to see why their portfolio hasn't performed as well in any given year. Are you kidding me? This is not about pick and choose what you think is the best index to compare your portfolio to. Your portfolio is not a cookie cutter process with Nepsis. It is an investment process of owning great businesses over time. Now, we invest globally. We own emerging markets, we own international as well as US. I've told our investors in historical updates, expect us to have a year where we underperform our metrics. We did this year. And the reason why I told them to expect it was because in the previous several years, we had significantly outperformed our metrics. The All Country World Index, ACWI, if you want a metric to look at, that's one to look at. But the bottom line is, folks, it's more important to know whether or not your portfolio is doing the best it can. And we believe it is. And if you knew all the intricacies of what was going on in those portfolios throughout this year, you'd be shocked. Now, we are extremely pleased with what the portfolios look like right now. 2017 right now, although it's short term, doesn't mean anything, have started out very well. We'll see how it goes. We'll talk about that in the market update here in a little bit. Folks, focus on your dreams, focus on your goals, focus on your objectives. Get off the bench and stick to the knitting. Now, this gets back to, that's all fine and dandy, Mark, but I still need to get returns. Folks, I've said it many times, returns are a result of a process. Process creates success. Success does not just happen overnight. And our process starts with, philosophically, being an investor in great brands, an investor in great businesses over time, and utilizing volatility to take advantage of buying more of those great businesses when they go on sale. They also, as a philosophy standpoint, require us to follow other metrics, dividends, long-term trends. If you'd like to know more about our philosophy and our strategy, go to nepsiscapital.com. We've got lots of information there about it. But what also helps you be successful over time, folks, is flexibility and transparency. Your ability to understand what is going on with your money and why. Do you get that in an index? Do you get that in a robo portfolio? A portfolio of lots of ETFs or mutual funds? Do you have flexibility? Do you have transparency? No. What Nepsis Capital provides you is a layer of transparency along with flexibility to provide you the opportunity to enhance your ability to be successful over time. And as we've been doing this a long time, history has proven that's been exactly the case here at Nepsis Capital. So we talked earlier about the volatility, corrections. When is that 20% correction going to come? I have no idea, nor do I really care. If you're a long-term investor, you shouldn't care either. Let's not sugarcoat this, folks. If you're worried about a 10 or 20% correction, you need to sit down with your advisor and reassess your investment objectives and your risk tolerance. Here at Nepsis Capital, we have created an investment policy objective setting questionnaire that is designed to get to the deepest levels of understanding what your true tolerance for volatility is, what your true tolerance for risk is. If that's not matching up, then you need to talk to your advisor. But the bottom line is, there's a reason why we do this proprietary investment policy questionnaire and proprietary investment policy statement. It is designed to give you the greatest handle on your investment objectives and tolerance for volatility and risk. Your portfolio is allocated in that manner. It should make volatility a moot point. If it's not, you need to reconsider how you're allocating your portfolio. But I will tell you, we look forward to the next correction. We will take advantage of it. And there's been corrections going on in sectors, there's been corrections going on in companies we own, and we've been taking advantage of buying more of those great companies on sale, and we're going to continue to do that. That leads me to the headline versus the bottom line. Hate to be repetitive, but it's the story of my life. The headlines are coming out more and more. The correction's coming. The inauguration's going to have a correction. We're going to have a crash when Trump becomes president. Now that Trump's president, the world's going to go to hell in a handbasket. and everything's going to crash. First of all, they said that with the blood moon too. They said that with Y2K. They said that with Brexit. They said that when Trump was inaugurated. How many times do you want the media to cry wolf for you folks before you turn it off and stick to the process? That's the bottom line. Stop listening to the headlines. The headlines are designed to create an emotional response out of you. You want to have a proper and appropriate emotional response? Stick to the knitting. Stick to the process. That leads me to the market update. What do we see happening in 2017? If you remember, last year we talked a lot about not being surprised if the S&P was up 10% this year. It was up pretty close. Again, emerging markets, international, were a drag. Particularly our China companies were a drag on our portfolios, along with a couple other things. Those are subsiding. They will subside. These are great long-term investments. This too shall pass. We also said don't be surprised in 2017 if the S&P is up 10 to 20%. I still believe it can happen. Do not be surprised if the S&P is up 20% this year. Now, I'm not speculating. I'm not prognosticating. I'm just telling you don't be surprised. I will tell you that structurally speaking, at this time, the policies that will be put in place will be very pro-growth, pro-business. You are already seeing, as we do this update today, Bank of America announced their earnings. Stock was up 1.5% last time I checked after their earnings. By the way, the stock, when the election happened, Bank of America was 16. Today, Bank of America is over 23. 16 to 23 is a big move in a couple months. We started buying Bank of America 5.5 years ago, 6 years ago, at 6. Not too bad. And we think the banks have a long way to go. Bank of America continues, along with Citigroup, to be one of our larger holdings for client portfolios for multiple reasons. It is well documented in historical documents I've created. The talk about banks have been undervalued for years. Fortunately, people are short-term thinkers, not long-term thinkers, and people have been underweight in the banks. Part of the reason why the stocks are moving so much is because managers are saying, holy crap, I need to own the banks. And so they're pushing the stock prices up. Will we take profits eventually in some? Of course, we always take profits in our businesses to manage the portfolio. Now, why is that? Very importantly, there is no one position in your portfolio that should make or break your portfolio's performance. It is the portfolio working as a whole, like a well-oiled machine. So as we look at the metrics, we look at the economy, we believe interest rates will continue higher. We've got the 10-year going from 1.65 to 2.6 after Trump was elected, pulled back to 2.4 right now. A year ago, what were they, 1.5? The uptrend is here, folks. Higher interest rates are coming. The long-term bull market's over. You want to own bonds? Enter at your own risk. I would tell you that process and appropriate allocation and diversification will allow you to be a successful investor over time, no matter what you own. Stocks, bonds, precious metals, real estate, dirt, wine, collectible cars, coins, I don't care. Appropriate allocation based on your risk tolerance and investment objectives is what is most important. Lastly, time for my shameless plug. I would encourage you to tune into our radio show. You can tune in on iHeartRadio, Investing for Success with Mark Pearson, or if you're in the Twin Cities where we are locally, we're on 1440 AM. It's 4 o'clock to 5 o'clock weekdays, shot live. Unless I'm busy, then we do best ofs. But this platform I've put out there to enable me to continually communicate the ideal of investing for success. And the idea that investing for success begins with investing with clarity. I don't have to do the radio show. I don't even solicit to try to get new clients out of it. It happens. But I've put that platform together along with these quarterly updates, folks, to continually communicate with you, to hopefully educate, lead, guide, and inform you to enhance your ability to invest with success. Thanks for listening in. Have a great day.